The same. I wish you all a very happy new year. So unfortunately, even this year we have to live with this environment. So we couldn't, or we won't be able to do revision classes in physical classroom. So we have to live with setup, and therefore we decided to go for online revision classes. So, but don't worry. Whenever you have a question, please raise your hand. Please interrupt me and ask your question. I'm not going to go through each and every topic and go detail, because it's not possible to do that within 4 weeks. So that means 16 hours. Within 16 hours, effectively, it may be less than that. So I'll try to revise you whatever the important thing. Before we move into the class, I would like to explain you what is our plan. So we have planned for 4 revision classes starting from today until 24th January. 4 revision classes. The first 2 will be done by myself, and the last 2 will be by Perry. So then either we can have a separate class for to discuss the past paper, or we can discuss the past paper during the revision session. And however, we are planning to have the exam on 21st February. So please note that we are planning to have the exam on 21st February, but subject to the approval from the health authority. The problem with having the exam here is because you all have to come here from different parts of the country. That's the concern that the health authorities have. If we can have centers in different districts or different locations, it wouldn't be a problem, but it's not practical to conduct exam like this for this course. So you all have to come here for the exam to get the approval. To have such arrangement is the problem. However, we are planning to have the exam on 21st February. So you have 3 weeks or 2 weeks study period. Don't wait until last moment. Get ready for the exam or do the preparation starting today. Any question before we move into the subject matters?
So it is one paper for 3 hours, right?
Yes. I think you have access to the last year paper. It's posted on the classroom.
So the same style and the structure will apply. Okay.
Probably.
Yeah.
Most
Thank you.
probably. Yes.
Thank you.
Anything else? Someone has raised the hand. I think Mohammed Niaz. You can ask your question.
So what about the assignment marks?
Assignment marks, we will announce everything at the end with the final marks. We are not going to announce it before that. Any other question? So be ready on 21st February. The exam will be held, but subject to the required approval. Okay, shall we start the class then, if you don't have any question? Oh, okay. Would you like to have a separate class for paper discussion, or shall we discuss during the revision classes?
It's better to have a separate class for revision classes.
It's better to have.
Yeah, we also think like that.
Okay, then in that case, we will have the class on 31st January. Otherwise, you can get 3 weeks for study leave. If you need a separate class, then you have only 2 weeks for study leave. Okay, then. So I'm seeing in that some of you respond to my questions on the chat. So better speak out here. I might not see all the messages coming. Even when you have a question, don't just drop the message. Just raise your question. Otherwise, I will miss out that, because I'm not always looking at this screen and not going through the messages and going to see one by one. You can see the board. Is it? Can you all see the whiteboard?
Can see.
You can see. Okay. Before I move into the revision of what we learned, I would like to give some comments on the assignment. General comments. I'm not going to give the full answer or answer for each and every question, but I'll tell you how you should, or at least what we expect from you when you give an answer. So if you take the assignment, first question, and there were few transactions, if I remember, 4 transactions, and you have been asked to identify the risk of each transaction, and at the end, when you aggregate all these transactions, what would be the risk and what are the regulatory requirements that you have to fulfill while you are engaging in these transactions and in related matters. So the first question is, your bank sell I think $1 million, if I remember, whatever amount, to a importer. Importer wants to buy dollars to make a payment. So what are the risks in that particular transaction? What are the risks? From the bank perspective, I'm going to discuss from the bank perspective. Generally, when it's not saying whether it's a forward or specific value date, what do you expect? generally we assume it's a spot transaction. If it is not given, specifically mentioned, what would be the value date, what is the value date, then we generally consider it as a spot transaction. So what are the risks? So you wanted to have a physical classroom. So assume now you are here in the classroom. When I ask question, if you don't answer, it's not now. Even now, there's no difference between having a physical class or a online classroom like this. Why do you need a physical classroom to have a better interaction, isn't it? So if you need interaction, take the opportunity. Even here you can ask your questions and you can give your answers. So please give your answers, speak.
Exchange rate risk.
Exchange rate risk. Yes, that's what partly correct. But when you say exchange rate risk, you have to be specifically say based on the transaction given, what is the exact exchange rate risk. You cannot just say exchange rate risk or credit risk or liquidity risk. That is very broad. When bank sells foreign currency to a customer, what is the specific exchange rate risk the bank faces?
When we sell foreign currencies, we are short in that USD or whatever the foreign currency. Then depreciation of the local currency against the foreign currency will affect the profitability of the bank.
Exactly. That's the risk. So you have to specifically say foreign exchange risk, and when with that transaction the bank goes up. That depends whether it's a short position or still you may have a long position, but your long position has decreased in amount, or you may have to buy it back from the market. So in that case, if rupee depreciate against that foreign currency, you have to pay more rupees to buy that. So you have to specifically say that rupee depreciation is the risk. It's the FX risk is true, but you have to specifically say rupee depreciation is the risk, because you should know what is the exact risk. Then only you can take some action to mitigate that risk. Okay, that's the first thing that comes with that transaction. What else? Is it all? Then what would be the impact on the net open position? If you were already in a short position, and with this transaction, it may go beyond your net open position limit from the short side. That depends on your current position. However, you can discuss that. There is a possibility that the net open position limit may reach. What else? And you have to comply with the other regulations. When you sell for an importer, you have to make sure that he's having a genuine underlying transaction. Otherwise, you cannot sell foreign currency to anybody. So that things you have to discuss. from the customer side, you have to make sure or do KYC to identify the customer, whether he's having the underlying transaction and things like that. Then, okay, you sell foreign currency. You may face liquidity problem in foreign currency. That depending on your position and your requirement, you can discuss that as well. But what would happen when you sell foreign currency? What you will get? You sell foreign currency against local currency. So you receive rupees. What is the impact on your rupee liquidity? Rupee liquidity will go up. Your rupee position will go up, increase. Then what do you do with that rupee? Then you may have to lend that rupees. So invest some. Then you face the interest rate risk at the time that you are entering into that transaction. So like that, you have to discuss all those things in a such broad question. The question is very broad, so you can discuss many things, but have to be to the point. You cannot just say FX risk, liquidity risk, interest rate risk. No, most of the transaction will have that risk. You take the credit risk of the counterparties. That's why you have to assess the customer and take some actions to mitigate the credit risk arising from the counterparty or the customer. You may ask the counterparty to park rupee amount required in his or her account. Then only you do the transaction, things like that. So you can't just say credit risk. You have to be specifically say, due to these reasons, this risk will arise. Customer may fail to pay required rupee amount. So therefore, there's a credit risk. So to mitigate that credit risk, what are the actions that you can take? Things like that. So then there will, without saying just liquidity risk or interest rate risk, you have to say there will be a rupee inflow. So the bank has to invest that, use somehow that rupee inflow to earn interest or earn an income. You can't keep it idle. So interest rate movements will have an impact on that. Things like that you have to discuss. So I'm not going to discuss each and every question. I think you get some flavor how you should answer the question. Please read the answer properly and be clear on what is the question, and try to answer the question without writing whatever related things that you know. It won't give you a good mark. You need not to write lengthy answers, but short answers, but to the point. Address the exact question. Then you will get full marks. Then if you move into the second part of that question, overall, considering all these 4 transactions, overall, what are the risks? What you can do? When you aggregate all these 4 transactions, then what do? You have to think about cash flows, NOP limit, because there were few foreign exchange transactions. Then that creates a NOP position. not on individual transaction, but all 4 transactions, there will be a position. Then you have to check whether that position within NOP limits or not. That position will give you a FX risk. If it is a positive position, then rupee appreciation would be a problem. If it is a negative position, rupee depreciation or the local currency depreciation will be the risk. Then prepare a cash flow and maybe a gap analysis in aggregate in terms of dollars and in terms of rupees. Then you can identify where you have a surplus cash and deficit. Then you can discuss about interest rate risk and liquidity risk that may arise due to this position. There was a bond purchase, government bond purchase. So you have to consider all those things. I didn't see that many of you have done this cash flow analysis, put it into a table and fill the desired bucket. So at least you haven't do the netting. What are the inflows, what are the outflows, and what is the net position? Only few have done that. When you are asked to do the aggregate position, you have to aggregate it. Do that. Okay, is it clear? Now you can, I think now I don't have to give you marks. You can have your self-assessment. You know what's the answer that you provide and what are the weaknesses in that answer. I think you will have some idea about your answer. Any question on that? Any question? No, if you don't have any questions, now we'll start the revision part. Okay. Do you have specific topics that you think you need more attention?
So the calculations are very important because we didn't cover much. So if you can do some calculations, it'd be better. The calculations which are coming like mostly in the paper, like I saw it's foreign exchange and bond calculations were there. So if you can like target on those, will be better. Thank you.
Okay. So are you all logged into Google Classroom?
Yes, sir.
So yes. So I just post a question. Did you get any message? Have you got any message? I'm trying to do it more interactive, let you know, participate in the class. I just posted MCQ question.
Yes, sir, it's there.
Yeah, you can answer that question. Take few minutes. Since this is a text, I put some about 7-8 minutes. But to answer this question, you should not take that long. You have 1 more minute. So I can see there are 36 participants in the classroom, but only 20 answered the, or 21. Answered the question. So the problem is you can't learn these things without doing, just by listening or looking at others. You can't learn. From beginning I mentioned, whenever there are questions like this, sums, formulas, you have to do. Write down the equation, relevant equation, then substitute the relevant numbers and work out. It first time or first few times you may get incorrect answers, but try it, then only you can learn. Okay, the question is, let me summarize. You invest US dollar 1 million. Can you see what I wrote on the board?
Yes, I can see.
You can see.
Yes.
Dollar 1 million invest for 180 days, and interest you receive US dollar 25,000. The question is, what is the interest rate? Okay, first of all, before I answer this question, if you want to recognize it, from which sector of the market this question comes from?
Money market.
Money market. So then, how do we calculate money market interest? What is the equation? So, what's the method we use in money market? We have two methods: simple interest and compound. Which
Excuse, sir.
one of
Sir.
these will be applicable? Yes.
Excuse, sir. If there's a black market, it's better to.
Okay.
Yeah. So it's a money market question. We have
two ways of calculating interest: simple interest and compound. Which one we are going to use in this question?
Simple interest. Simple interest.
Simple interest. Yes, we are going to use the simple interest method. How are we? What's the equation? It is only simple interest. Interest equals principal amount into interest rate into then time. This is principal. This is interest rate. This is time. In time, it's in years. So in this case, it's only 180 days. We have to show it as a so in terms of years. We'll try to substitute numbers here. Interest amount, do we know now? Yes. What is the interest received is $25,000. That is given. Principal amount $1 million. R, that's the one which we don't know. T, $180 days. So we have to write it in years, and we assume in money market for dollars they are around 360 days per year, and the concern period for this transaction is only 180 days. Then you can do the calculation. If we solve this, this would become then this would become 500,000 into R equals 25,000. Therefore, R equals 25,000 divided by 500,000. So the answer is 5%. Clear? So out of 36, 39, 27 has responded. Out of that 27, 23 has given the correct answer. So you know what's the answer you provided, you know whether the answer is correct or wrong. So the answer is 5%. people, those who didn't do this adjustment, they might get a different answer. That means if you just divide 25,000 by 1 million, then you get 2.5%. Correct? That's what you reach. Those who get the answer as 2.5. The mistake you did it, you forgot to adjust it for the time. Correct? Any question? Any question? So if you don't have any question, I'll post another question. So please answer that question. Okay, only 5 of you have answered the question. I don't know what's the difficulty here. This summarizes the question. There's a financial asset which gives you 10,000 rupees each year, starting from 1 year
The board
from
is not
today.
clear.
Sorry?
Board is not clear. Ah, no. Now okay. Now fine.
Oh, fine. Okay. So there's a financial asset which gives you 10,000 rupees per year, starting from 1 year from today and every year. So cash flow would be like this: 5 10,000 payments, annual payments. This is equal 0. That means today and you need 9% return. Then if you want to buy this asset, how much will you pay? That means what is the price of that asset? That's the question. How do you calculate it? If you can remember, we discussed thing called annuity. When there is a series of cash flow, we call it an annuity, and when the payments are in equal amounts, we call it an ordinary annuity. So then how do you calculate the price? That means the present value of these cash flows. What is the present value of these cash flows? If we need a rate of return of 9%. How do you find the present value of an annuity? Can you remember the equation? This is the equation. What is A? That's the annuity payment. What is R? That is the interest rate or the required rate. What is N? Number of payments, assuming N. So now you know the terms. Substitute here. A equals, what's the amount of A?
So the board is not clear.
Board is not clear. What does it mean that?
It's blurred.
The
It is
video is
blurred. Yeah,
clear.
and now it's okay.
Okay. So what is A? What is A?
Is
A is 10,000.
A is 10,000. That is the payment annuity amount. 9% is the R. N
N is 5.
N is 5. So then substitute these figures into this equation. 10,000 divided by 9%. Remember, it's 9%. So you have to write it as 0.09. Then 1 minus 1 over 1 plus 0.09 to the power 5. Better to use your calculator now. Now you may have access to Excel, but don't use it. Use your calculator and get the answer. It should be 38,000 38,896.5. 38,896.5. Clear? This is, in a way, this is the easiest way. If you can remember the equation, this will save your time. But this is not the only way to do this. Is it okay if I erase the board?
Can you say, please do a calculation for the annuity due as well using this
Sorry?
formula? This is the ordinary annuity, sir.
Yes.
Can we do the same calculation for the annuity due that means cash flow occurs now?
Yes. That can be done. Yes. I'll come into that. So in this case, that's a good point. The first payment is after 1 year, not at the beginning of the period, at the end of the period. But there can be instruments or annuities where you receive the payments at the beginning of the period. We'll move into such example. Before that, let me know whether there's another way that you can do the same calculation without using this equation. To explain, before we explain that, is it okay to if I erase the board? I think you have sufficient time, and if not, you have the recording access. What is the other mechanism that you can use to find the present value? What's the other mechanism? Calculate the present value of each and every cash flow. What is the present value of this? It is 10,000 divided by 1.09. What is the present value of the second cash flow? It is 10,000 divided by 1 plus 0.009 to the power 2. You can do the same here. 10,000 divided by 1 plus 0.009 to the power 3, the time. Ten thousand divided by 1 plus 0.009 to the power 4. 10,000 divided by 1 plus 0.09 to the power 5. Okay. B, C, D, E. A, B, C, D are the present values of each cash flow. Then present value of the annuity is the A plus, B plus, D plus, D plus. Add these together, you get the present value. Still, you should get the same answer. But in this, it will take time for you to key each and every time, and it takes time. So that therefore, it's bit slow method. But in this method, you don't have to remember any equation other than just the way of calculating the present value of a one future cash flow. Is it clear? So you can use either annuity equation or this method, but there are pros and cons. To use the annuity method, you should remember the equation properly. Otherwise, you will get a wrong answer. In this method, you don't have to remember the equation, but it takes time to perform the calculation on your calculator. It's up to you to choose whatever the method. So before I move into the other type of annuity, first let me summarize two equations to calculate a present value of, how do you calculate a future value of a present value given a interest rate? But in this equation, n is the number of years, r is the annual interest rate. But whenever there are more than one interest period per year, that means whether it's semi-annual or monthly, something like that, that if we denote that frequency as m, then this equation changes to r over m to the power m times. Can you remember? We discussed. And from this equation, you can do the reverse calculation to get the present value. That is future value divided by 1 plus r m to the power. If you know the future value and the interest rate, coupon frequency, number of years, then you can calculate the percent. This is for just a one cash flow, future value of the. If you know this, you can calculate present value of each these cash flows. Here we assume annual payment. So therefore, M equals 1. Clear? This is not the simple interest. This is the compounding. Any question? Any question? Okay, if not, we'll consider the other one. Instead, so consider the same example. There are 5 cash flows, 10,000 each, but the payment is made at the beginning of the period. That means you receive 10,000 today or you pay 10,000. So T equals 0. But you get 5 payments. T equals 0, 1, 2, 3, 4. At the end of the 4th year, you have received all these. What is the present value of this series of cash flows? What's the difference? What is the present value of this 10,000? What is the present value of this 10,000?
10,000.
10,000. So you need not to do any calculation. But there are another 4 payments. So you can use this cash flow as it is and calculate the present value of other cash flows. So what you can do, it is like a annuity of 4 years with each 10,000. Use the same equation. Present value is A over R, 1 minus 1 plus R to the power n. But in this example, A would be still 10,000, R would be 9%, but n only 4 years. Calculate the present value of these 4 cash flows and add it to the current cash flow. Then you get the present value of the everything. Clear? So this is that you have to build, because you have to segregate the questions into different parts and use the existing equation or whatever the equation or methods that you, or instead you can calculate present value of this 10,000 is 10,000, present value of the cash flow at the end of one year, calculate that present value, calculate the present value of the second cash flow, like that. Same thing. So in this equation, in this method, it would be 10,000 plus 10,000 divided by 0.09, 1 minus 1 over 1 plus 0.09 to the power 4. You would get the answer. Clear? So you should be able to move from what you know to the unknown. Your answer would be 42,397. Any questions? So in these exercises, so these are the things that you should, in the simple interest method, future value would be present value plus present value times 1 plus R into I'll put it in this way. In the money market, this is the way. Present value. If you want the full future value, if you need the interest only, then PV times this part. Then last. So if I break it, this is PV plus PV times R into P over number of present value plus present value times the interest rate into the day proportion. So this is only the interest. This is the principal amount. When you add them together, you get the future value. If you want to calculate interest only, what you need is that the first example that we did. But if you need the full value in the future, then you can use this. D is the number of days that we consider. If it is 3 months, that may be depending on the market. If it is 360 day count basis, 3 months would be considered as 90 days. In a 360 day count basis, 3 months would be considered as 90 days. But it can be actual 360. Then 3 months, it can be 90 days or 91 days, depending on the actual number of days between the origination and the maturity. What is the actual number of days between these two? Then you have to use that actual number of days. Take a calendar and count the actual number of. So this is the basic equation. Then yes.
So small question. I'm talking about the previous calculation and the first calculation. Okay.
Mm-hmm.
At the first calculation, we have taken the time period as 5.
Yes. First calculation, you mean the second question? The first method. Annuity question. 10,000 payment.
Yeah. What's the difference of in both questions? The difference of asking.
The difference is, say, this is today. This is after 1 minute. In the first ordinary annuity, we assume we receive the first payment after 1 year's time. This is the first one. In the second one, today we assume we receive the first 10,000 rupees today. Is it clear?
Yes.
So in this case, in 4 years, everything is completed. 1 year, 2 years, 3 years, 4 years. But in this case, you received it in first payment is in 1 year's time. It will take 5 years to complete. So this 10,000 you received today, the present value of 10,000 is 10,000. But in the first case, even the first payment you received in future, so there's a future value for that. Is it clear?
Yeah, thank you, sir.
Okay. Okay. This is the simple interest method that we use in money market, but in other products, we calculate future value based on this equation. As I explained earlier, present value is the current principal value. R is the annualized interest rate. M is the number of interest period within a 1 year. N is the number of years. Clear? If I put an example for this, assume 10,000 payment every 6 months. Instead of 10,000, I make it 10%, and the present value is 100,000. Interest is accrued every 6 months. Oh, sorry, interest is paid on every 6 months. So then what would be the future value? Sorry, not interest paid, sorry, interest accrued. The payment will be at the end of 5 years. Say 2 years period. Then if I put it there will be, even it's 2 years, there will be 4 periods. 4 periods, but each is a 6 month period. This is also a 6 month. This is also a 6 month. This is also a 6 month. If you invest 10,000 here, what would be the amount that you received after 2 years? Payment 10,000 means interest rate is 10. Sorry, forget about the payment. We put it into the interest rate. R is 10%. You have investment 100,000, interest rate, annualized interest rate is 10%, and interest is compounded on 6 month basis. Then if you use this equation to calculate the amount that you are going to receive in 2 years time, you have to use this equation. R over M, M into N. PV is clear, present value 10,000. What is M? What is N? Every 6 months. So there are 2 interest periods. Therefore, M is 2. And it for 2 years. N is also 2. This M goes here and here. This N goes. Then you can calculate the future value of what would be the amount that you receive in 2 years. Future value would be 100,000, the present value, plus 1 plus 10%. Remember, it's a percent. You have to substitute it as a decimal. 10% as a decimal is 0.1. But there are 2 interest periods per year. So divided by 2 interest period for 2 years. So therefore, there are 4 semi-annual periods. So whatever the answer that you get, that's the amount you received at the end of 2 years period. That's the equation of future value. You can use the same equation if you know the future value to calculate the present value or the interest rate for the number of years or number, frequency, whatever it is, if all other variables are given. Any question? And the other equation that you should know is what is the effective annual rate. When there are more than one interest period during the year, what would be the effective annual rate? How do you calculate it? 1 plus R over M M minus 1. What is this R? I'll put it RS. That's the interest rate quarter. Seasonal interest rate. So even for in my previous example, interest rate is 10%. 10%. This is annualized rate, but for a 6-month interest period. So this is the effective annual rate. So these are the basic equations that you should know to perform most of the calculations.
So what is RS and R difference? You put that RS mean the seasonal?
No, in this RS and the R both are the same, but here EAR, this is also an interest rate. This is the effective annual rate. Just to distinguish between this and this, I put this RS. Whatever the quoted price, quoted rate, annualized for that particular season or particular period. If it is a 3-month annualized rate, RS means the 3-month rate. Okay. Any question?
For that one also, can you use an example? So then,
Yes, if we use that 6 month, 10% rate, what is the effective annual rate? 1 plus 10%. So, 0.1, how many what is the frequency of interest? It is 6 months. How many interest periods per year? 2. Divide by 2, multiply to the power 2 minus 1. So basically 1.05 to the power 2 minus 1. Would it be more than 10% or less than 10%?
More than 10%.
More than 10%.
More than. So whenever you get an answer, check whether at least you get the direction correct. Maybe the still final answer may be wrong, but at least we have got the direction correct. Is it clear?
yes, sir. Thank you.
Okay. So basically, this equation and we didn't do anything on the annuity to calculate the future value. This EV this equation is the how to calculate the present value of annuity and if I write it here, can you see this side of the board? Future value A times 1 plus R n minus 1 over R. This is the if you want to calculate the future value of annuity, ordinary annuity, this is the clear. So basically this 1, 2, 3, 4, 5 equations. You should master these. Whatever the variables given, then you should be able to find the other one. So in this equation, how many variables? 1, 2, 3, 4. when there are three variables given, you should be able to find the fourth. And to combine these, so as we did in the previous example, when you have a annuity due, the first cash flow will be received today. Then you should be able to identify that there's no the future value will be same as the payment. Then take it out and use the remaining cash flow as the annuity likewise. When there are unequal cash flows, different cash flows in different times, how to calculate the present value of all these cash flows. Then you have to use this equation to calculate the present value of each cash flow separately and sum them up. So these are individual, but you should be able to combine one or two together to get the answer. Any question? Any question on this? Yes or no? Any questions? Any questions?
Okay, sir. No.
Okay. Then I'm going to post another question. Okay, I just posted another question. Just try to answer.
Hello, sir.
Yes.
When calculating the future value of the annuity,
Mhm.
hello.
Yes.
If cash flow occurs at the beginning of the period, do we need any adjustment to the formula?
Now that's what. If the cash flow is at the beginning of the period, the first one,
Yeah.
it
Yes.
it won't use in the equation.
Yes. Yes.
That's it. That's the adjustment that you have to do. Not to the formula, but how do you apply? Say if you receive the cash flow today,
Yes.
then the present value is same as the payment. But if you
Yes.
receive that cash flow in 1 year's time,
Yeah.
then present value is not same as the amount that you are going to receive in 1 year's time.
Yes.
So therefore, for the cash flow that you receive today, you don't have to use any equation. For many calculation, you can just take it as it is, but calculate the present values of future cash flows using the equation.
Okay, sir.
Say,
Thank you, sir.
today is January 3rd. Say, if you receive the cash flow each year, January, say assume January 1st at the beginning of the year, January 1st for 5 years, and
Yes.
today we receive the first one, and the next
Yeah.
one will be in 1 year's time.
Yes. Yes.
So you receive it at the beginning of the year.
Yeah.
That's true. Beginning of the calendar year or whatever the year that you are considering. But the very first one is at the beginning now. So the present value is same as the payment. But the next one would be after 1 year's time. So
Yes.
therefore you have to discount it by 1 year. The second one would be in 2 years' time. Then you have to discount it by discount it for 2 years.
Yes.
Clear? But
Okay.
if we assume the cash flows are at the end of the year, at time 0 today you don't receive anything. But the first cash flow you receive at the after 1 year's time. So you discount it for 1 year. The second cash flow you will receive at the end of the second year. So you discount it by 4 2 years. That's how.
Yes.
That's the difference.
Okay, sir.
It's
Thank
a timing matter.
Yes. Yes.
So we'll close this. I got 11 answers. Out of that, 10 is correct, 1 is incorrect. What's the correct answer? That go for the annuities is the best because that has a greater present value than the 2 million amount. So, but few are now, I got 2 more answers. That is also said that present value is less than 2 million. I think that because of you mixed with the immediate payment. Say in this question, annuity with 20 payments of rupees 200,000 a year with the first payment starting today. So then you don't have to discount that. You have only 19 future cash flows. Then you have to discount it only for 19 years, not for 20 years. Okay, simply this is the annuity problem. The lump sum that you receive 2 million today, nothing to do with you have a present value of 20 million. Then the problem is T equals 0 also you receive 200,000. Then every year you receive 200,000. The first one you receive today. So the present value of this 200,000 is 200,000 itself. Then how many payments in future? It's altogether 20. If you receive one today, the remaining are only, there are only 19 payments. Correct? Is it clear? This is how, this is about understanding the question. It's not about the equation or how do you use the equation. This is about the understand the timing of the cash flows. This is very critical. You should be able to understand the timing of cash flows. So read the question carefully and try to figure out. Now, what you have to calculate the present value of this annuity. This is as it is A. Present value of this 200,000 is same as A. Then the others you can calculate using the equation. In this A equals, if you want, you can do some calculation and get another answer to use in this. But I think then you have to remember another equation. But adding this number won't give you a lot of, it won't take lot of time to key in this number and add this. So therefore, better to use this method rather than remembering another equation. You can manipulate this and solve this and get another equation, but better to use this method. So what is A? 200,000. What is R? Was it 8%?
8%.
8%. So 0.08. Then what is N? 20 or 90?
90.
It's only 90 because the first payment you received today, that is the payment that we consider here. You put that numbers here. So you should get 210 some. $2,120,000 9.8. Correct? So this is more than 2 million. This is more than 2 million. So therefore better to go for the annuity instead of taking 2 million lump sum today. What are the risks? If you go for that, what is the risk? Or is it without any risk?
Changes in interest rate may
Yes.
affect the
Yes. Okay.
Percentage
Changes
of
in
cash.
interest rate, whether it's increase or decrease. Which one would be the in your negative side?
Increase in interest rate.
Increase in interest rates. Why? If you had that 2 million today, in few years time, you can invest it at 8%, as this gives, as at today interest rate is 8%, you can invest it 8%. But when the interest rate goes up, you can reinvest it at a higher rate. But if but in this case, you won't get. So that's a different thing. However, in these things, when we do this comparison and make a choice, we have some assumptions. Based on that assumptions only, we make the decision, and you should know what are the risks. Is it clear, the calculation? I think it should be, because most of you have done the calculation properly, but I would say not answer the question properly. Some of the answers is the figure, this figure. But what's the question? Question asks which option has the greatest present value. Then the answer should be the annuity option has the greatest present value, not the figure. You have to do the calculation and get the figure, that's true, but you have to make the comparison and give the final answer. Some of you have just put the this 2.1 million figure. So those are the mistakes that you do. So try to answer the question. Okay. Any question? I think this part is now enough clear. Now we have to move into the discounting products. In money markets, we discuss about interest bearing products and discount products. So all these are, though not some of them are not money market products specifically used in money market products, but this is interest calculation in different products, but with interest bearing products. Now we have to discuss about the discounting product as well. So before we move into that, I think it's a good time to take a break. Before we go for the break, do you have any question?
When we are answering, sir, do we have to state the assumption also in the answer?
No, if not asked, no need.
Okay, thank you.
Just answer the question. That's the other thing. No need to tell all stories, but answer the question. If I ask what are the risks, then you have to say this. Or if I ask which assumptions that you made this decision, then you have to explain the assumption. Any other question? If not, we'll take a break here, 15 minutes break. Now it's 10:30, we'll come back 10:45. So be ready with the other things that we are going to discuss. First about discount products, and we'll try to move into FX calculations and bond calculation today. Okay, we'll take a break. Only 10 has responded. There are 36 participants in the class. Okay, can someone explain the answer? Can somebody explain the answer?
So this future value is given, and
Mhm.
hello, you hear me, sir?
Yes, 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 I can hear.
All right, okay. Future value is given, and even in the present value also given. We need to see the we need to calculate the interest rate R, but
Yes.
only thing we need to discount it to 360 days, because it says day convention is 365.
Yes.
We need to future value equals present value 1 plus R divided by 360 over 360 over 365.
Yes.
Then I got the answer 6.34.
6.34. Let's see. Any other answers?
$6.52.
6.52. How did you get that answer?
Yeah, here the interest portion is the difference between 2.26 million and 25 million. That is for the 25 million, and in addition that is for the 360 days, and that rate converted to 365 days.
Yes. Okay. I think that's the correct answer. We'll see. Okay. The future value is given 26 million and 600.
607 607,013.
Right below, sir. Can't see.
607,013.
So can you write below, sir? We can't see the like.
You can't see that.
Yes.
Yeah, slightly below better, sir.
Face value 26,607 and
013.
013. And the present value is
25.
25 million. What is the time? What's the time period? For how long?
360 days.
Yeah, 60.
For how long you get this? You invest 25 million and you get 26 million and 607,013 dollars or rupees in how many days? In how many days?
360 days.
360 days. It says on 360 days. But what does it then? You are asked to calculate the rate of return or the interest rate. What does it mean by rate of return on 365-day count basis? That means we have to assume per year there are 365 days. Okay. So again, is it a money market, a simple interest problem, or a compounding interest problem?
Simple interest.
It's a, again, simple interest. Either you can go for this equation as it is 1 plus R into T. Now you have to find this R. Again, either you can substitute figures here while it is in this form, or you can rearrange it to get R. This R equals FE over PV minus 1 and 1 over T. Correct? So now what you have to do? Substitute figures. What is FP? Future value is 26,607 and 13 divided by 25 million minus 1 into 1 over T. What is T? If you have to substitute T here, what is T here? What would be the figure? It is for 360 days based on 365 day count. So therefore, T equals 360 over 365. But here we need 1 over T. 1 over 360 divided by 365. That means you can rewrite it as whatever this. I think when you solve this, it comes as 6.4 something into 365 divided by 360. You would get 3.517. Sorry, 6.52%. Okay, this is a sort of mechanical process. You have an equation, you just put numbers, you get this answer. But intuitively, how do you do this? Without memorizing any equation, how do you do this?
We can calculate that 1,607,000 over 25 million. Then we get
Yes.
a
What is
rate
the
and
interest income over the investment. So what is the interest income? That is 1,607 and 13 over 25 million, and you can make it a percentage if you want. Don't worry about to make it a percentage now. What is the figure that you get?
6.42.
6.42. Because if you make it, okay, a percentage, then you get 6.42. What is this? This is the holding period return. We, we, we didn't think about for how long that you have hold this or make that investment, nothing. Just the interest income and the amount invested. We get this figure. So that means for a 360 days, for a 360 days, we get this 6.42. Then what is the rate of return for 1 day? What is the return for a 1 day period? This is for 360 days. Holding period return for 360 days. What is the rate of return per day? Then 6.42 divided by 360. Then you get the return for a 1 day. What is the return for a 1 year? That means how many days per year? In this example, 365 days. If you know the return for a 1 day period, you can calculate that return for a 365 days. Can you hear me?
Yes, sir, I can hear you.
Yes, it's clear now.
You can see the board properly in the correct
Yes.
cycle. Okay. So what I was telling, if we know the 1 day return, rate of return, that is 6.4 over 360, we can calculate the rate of return for a 365 days, which is 1 day return into 365. Then you get 6.52. You divide by 360 multiplied by 365. So you should get a return more than this. Can't be less than that. I think those who got 6.3 something, you did it other way around. Instead of
Yes.
divide by 360 and multiplied by 365, you might have divide by 365 and multiplied by 360. That may be the reason that you get 6.39 or the other answer. Yes, 6.34. That may be the reason. Is it clear? Either you can go by the equation or you can use your knowledge to get the answer. Any question? Only 16 respond out of 38. I don't know the reason.
So has a date for the exam been fixed as yet?
Yes, I announced it at the beginning. It's 21st February. Most probably, if we get the permission. Okay, so we'll move into straight away. We'll move into bond pricing. Then we'll come back to discounting, discounted product later, because this bond pricing is mostly related to what we discussed so far. Okay, I'll post another question now. Try to answer that as well. I'll give you only 4 minutes. Okay. What's the answer? What's the answer?
$828.40.
828.4. The answer is correct. How many minutes that you took to answer this question? About 6. At least 5 minutes. So, to answer this question, do you have to perform any calculation? Do you have to perform any calculation to answer this question? No. Why? This is an MCQ question. The answers are given. You can eliminate some answers. In bond calculation or bond pricing, what is the relationship between bond price, face value, coupon rate, and yield? If the yield and coupon rates are same, what would be the bond price? If the coupon rate and the yield are the same, what is the value of the what is the price?
The price trades at par.
It's par. It's traded at par. That means price equals the face value.
Face value.
If the yield is higher than the coupon rate,
Price will go down.
price is less than the face value. If the yield is lower than the coupon rate,
It's
if the yield is less than the coupon rate, the yield is less than the coupon rate, then what would happen to the price?
Price at a premium.
If the bond trade at a premium, then the price is above par. That means above face value. Okay, then this question, what is the coupon rate?
10%.
10%. What is the yield?
15%.
15%. Is the yield higher than the coupon rate?
Yes.
Yes. Then the bond is
price
trading at a discount.
Discount should be less.
Should be less. Out of these 3 answers, only one is
Less. No.
so. See, no need to do any calculation. So at the end, you will tell me the time is not enough. That's because you don't have the understanding about the basic. Clear? Is it clear? So in the MCQ type, if it is not an MCQ that you have to do calculate the do the calculation and get the answer. But in this, it's not necessary. You can eliminate other answers and get the answer. Okay. The answer is now it's clear, 828.4, but we'll try to calculate it. How to do the calculation? Can someone tell me how can we calculate the bond price? The information given is summarized here. It's for a 5-year period. Face value is 1,000 rupees. Coupon rate is 10% and it's semi-annual payment. Yield is 15%. How do you calculate the bond price? There are two ways. One is use the cash flows. What's the price of the bond? I'm not asking what is the figure. What is the definition of price of a bond?
Present value of the future cash flow.
Present value of the
Future
future cash flow. So the price is the present value of future cash flows. So if it is the definition, what you need to know, you should know what are the first thing you should know what are the cash flows. And to calculate the present value, you need timing and the required rate. What is the required rate? It is the yield. Timing, so what are the cash flows and when do you receive all those cash flows? It's a 10-year bond. Every 6 months,
So please write below.
and that file you can see. Since the coupon is paid semi-annually, there will be 10 cash flows. Every year there are 2 cash flows. During 5-year period there will be 10 cash flows. This is at the end of first month. This is at the end of this is at the end of first 6 months for the semi-annual period. This is at the end of the first year. Then after 1.5 years, 2 years, 2.5 years, likewise. What are the cash flows that you receive? To decide these cash flows in a bond, the cash flows, there are 2 cash flows. What are those 2 cash flows?
Interest payment and at the end of the maturity value.
Better coupon payment and the face value at the end. How do we calculate the coupon payment? How do you calculate the coupon payment?
Maturity value into coupon rate.
Face value into coupon rate. Is it correct?
Over number of payment per year.
Divide by the coupon frequency. That means how many coupons per year. In this case, semi-annual coupon means for each year there are 2 coupon payments. So face value is 1000. Coupon rate is 10%. 0.1 divided by 2. What's the figure that you get? What's the coupon amount? It is only 50. 10% of the 1000 rupees is 100 rupees. 100 divided by 2, 50 rupees. So in every 6 months you get 50 rupees. But on the last payment, other than this coupon payment, there's this face value payment. So therefore, in this cash flow, it will be 50 plus 1000. This is one of the equations that you need to know. How to calculate the coupon amount or the coupon payment. It is required to decide the cash flow of a bond. If you know the cash flow only, you can calculate the price. Clear? And timing depends on the frequency and whether these figures 1, 2, 3, 4, whether these are years or semi-annual periods or months, that depends on the coupon frequency. Okay. Now, how do we calculate the price? How do we calculate the price? Now we have decided the cash flows and timing as well. What is the equation of a bond price? Cash flow 1, discount for a 1-year period. Cash flow 2, discount for 2 periods. Likewise, end cash flow, discount for n number of periods. What is this K? What is this R? R is the yield. K is the coupon frequency. Remember, this R is the yield, not the coupon rate. R is the yield. K is the coupon frequency. In this, it is semi-annual. K equals 2. Clear? Now, in our example, this example, what is simple in how many periods? In semi-annual periods. It's not the number of years. It's how many semi-annual periods. So what you have to do, discount or calculate the present value of each and every cash flow and add them up. This is what this equation says. Present value of the first cash flow, present value of the second cash flow, likewise present value of the last nth cash flow. Add them together, you will get the price. So in this example, price equals 50 divided by 1.05. But why this 1.05? 1 plus point divide by 0.1 divided by 2. 1 plus 0.1 divided by 2 is 1.05. Second cash flow, again the amount is 50 rupees. Discount for 2 periods. So that's why to the power 2 is taken. Third cash flow, 1.05 to the power 3. Likewise, you have to do 10 cash flows. The final one is 1050. It's not only 50 rupees. With the face value, it's 1050. Either you can discount it as two separate cash flows, 50 and 1000, but it should be 10. There won't be any difference. 1.05 to the power 10. So you calculate these figures, add them together, then you will get 128. So 828, 39 something. So closely 828.40. Clear? Remember this equation and what is behind this. That is, this is the present value of future cash flows. So now earlier we learned how to calculate the present value of a future cash flow. Only difference here is this adjustment. Interest rate or the yield is given on annual basis, that has to be adjusted for the coupon frequency. If it is a semi-annual bond, you have to divide it by 2. If it is annual coupon payment, then you need not to do anything. But if it is a monthly coupon, then you have to divide it by 12. If it is quarterly payment, you have to divide it by 4. Likewise, the coupon frequency will change depending on the given bond. Any question? Any question?
Sir,
Yes.
the R is 15, right?
R is 50. Sorry. Yes. Then this has to be 0.75. Previously, I explained how to use this. That is 1 plus 0.15 divided by 2, not 10%. That's the coupon rate. Yield is 15. So 15% means 0.15. 0.15 divided by 2 is 0.075. So add it to 1.075. So everything should be like that. 1.075 to the power 2. 1.075 to the power 3. Okay. This is a common mistake. Instead of the yield, you will use the coupon rate. But once you perform the calculation, what would be the answer that you get? Instead of 828.40, if I did the calculation with this 1.05, I would get the answer as 1000 because coupon rate and the yield are the same. But I have that in mind. Since the yield was higher than the coupon rate, it should be less than 1000. So the answer is 1000. I should realize something is wrong. In this instance, that didn't happen because I didn't perform the calculation here. I just took it from the Excel sheet I worked out. I just wrote the answer, but you perform it on the calculator, you should get the answer 1000. The moment that you get the price as 1000, same as face value, you should realize something wrong, because when you read the question, you should realize the yield is higher than the coupon rate, so it's at the bond should trade at a discount. That means the price should be less than 1000. When you read the question, try to figure out that without jumping into give the answer. Just try to figure out whether you can find some relationship. In the question that I have posted, it's an MCQ. Definitely, you should be able to answer the question without doing this calculation. But only thing, you may have to perform the calculation if there were two answers less than 1000. Then you cannot distinguish or identify which one is the correct. Then you have to do the calculation. Clear? Any question?
Clear, sir.
Yes, clear. Okay. Is there any other way? Now you can see it's a 5-year bond, semi-annual coupon. You have 10 cash flows. You have to do this calculation 10 times. Is there a shortcut? Is there any shortcut?
Calculating the present value of the annuity.
Sorry?
Calculating the present value of the annuity payment.
Yes, exactly. So you can see there's a level cash flow, series of cash flows, the same figure. Other than this, so you can consider this payment as an annuity. And use the annuity equation to find out the present value of these coupons and add the present value of the face value. That can be done. So that's right. Whatever that now we discuss, learn, you should be able to use those, combine different things to answer one question. You may have to combine those things. In real life also, that is the situation. So that is something that I cannot teach for each and every situation. That is your ability to analyze the question. So to get that, you have to do or face a lot of questions. We collect experience even in our life while facing for different problems. Then we know how to face that sort of the experience that and we learn. Okay, what is the present value of annuity? What's the present value of annuity? Is it correct? Okay. Now, what is R here? That is very critical. What is R here? What is A? What is R?
0.15 divided by 2.
0.15 divided by 2. Again, this is semi-annual periods. The equation doesn't recognize whether it's annualized or semi-annualized, whatever. But what we have to give, whatever the period, the applicable interest rate. So it is 0.075. What is A?
50.
50. Then you can substitute these figures here. You should get 50 over 0.075 plus 0.07. 50 over 0.075 1 plus 0.075 into what is N? We have 10 cash. Again, remember it's not 5 because now we have semi-annual periods. We have 10 periods minus. You should get an answer here. But this is the present value of coupon. This is PV of coupons. We need one more thing. What is that? Present value of this 1,000 rupees.
Face value.
That is the present value of face value. Face value is 1,000 rupees. We have to discount it back for 10 semi-annual periods. The applicable rate is still 0.075. 1.075 to the power 10. The price of the bond would be X plus Y. Still, you should get that 820.4. Clear? So, how to use the annuity equation to price a bond? Any question? Is it clear? Any question? Okay, I just post another question. You have only 2 minutes to answer that question. Okay, only 11 has responded. What's the answer? So it's a 90-day treasury. The discount rate is given 3.91. The face amount is 10 million. For a discounted product, will you pay less than the face value, or exactly equal to face value, or more than face value?
Less than face value.
Less than face value. So it should be less than 10. The amount that you pay is less than 10 million. Can you calculate the amount for the exact amount, exact price that you are going to pay?
9,623,712.
Yes, maybe, but only concern here is you can say too little information because it's a 90-day, that's true, but what is the day count rate that you use? But you should know. It says this is US dollar treasury bill. What is the day count convention that they use? But here, let's assume what is the day count convention that you assume there to get that answer?
365.
365. Okay. Okay, we'll use the same numbers, but we'll assume Sri Lankan rupees. So, number of days, 90 days. Day count basis, actual 364. That is the Sri Lankan convention for treasury bills. Face value, rupees 10 million. So then what is the consideration? For amount to be paid. What is the amount that you are going to pay to buy this treasury bill? If the discount rate is 3.91, if you can remember, we learned IC equal face value times 1 minus discount rate into D. D means number of days over 360. We learned this equation. You can use that to calculate the price. So this is the discount rate 3.91, number of days 90, day count basis 360, so face value is 1 million. That's the way, if you remember the equation, what to do. But if not, what is the way that you can use? You can calculate the discount. This discount rate is applicable for, this is the annualized discount rate, 3.91% for 364 days. Then what is the discount applicable for 90 days? What you can do, for 90 days would be 3.91 divided by 364 into 90. This is the discount rate applicable for 90 days. This is 90-day discount rate, but it is annualized. What is the rate that you get here? $3.91 into 90 divided by 364. $0.967. Correct? If it is the discount rate, what is the discount? What is the discount amount? Apply that discount rate on this. And remember, this is a percentage. This is 3.91%. This is also percent. So apply this discount rate on face value. .967 divided by 100. Seven. It's only
9667.
yes, 9667. If you want to, yes, better to go for the whole decimal place. You can see just a rounding off for the third decimal place and going for the third decimal. Sorry, round off for the third decimal place and go for the second decimal place or the fourth decimal place. The difference. I just rounded off it for the third decimal place. That's why I wrote it as 967. But the exact figure is 9667. So you can see when it comes to million, it's a substantial amount. So this is the answer. Clear? So either you can use the equation, you can remember, or just use your knowledge. Any other? Is it clear? Any question? If not, I'll just summarize quickly about the discounted product. What is the discount? That's the difference between face value and the
Future value and
price that you paid. This is face value and the price that you paid. The difference is the discount. But what is the discount rate? It is not just the discount over face value, because we calculate the discount over the face value, not over the price. The discount rate is on the face value. But this is for a particular number of days. It's not for a 1 year period. Assume number of days is D. So this discount rate we divide by D, then we get what's the discount rate per 1 day. Then multiplied by 364 or 360 or 365, depending on the day count convention. So this is the annualized discount rate. That's how we calculate the discount. Then what is the price? Price is the face value minus discount. Price is the face value minus discount. From this equation, we can calculate discount. Discount is discount rate into face value multiplied by number of days divided by 64. This is the discount. If you substitute this part here, face value minus discount rate, face value into D divided by 364, you will get that equation. That I wrote face value 1 minus discount rate into number of days divided by 360. This is the price. So these are the relationships between discount, face value, and price, and the discount. I think this is key that you have to understand. Just discount divided by the face value, it won't give a annualized figure. We have to annualize it, adjusting for the number of days. Then you can do all those things. Then, what is the yield of a discount product? Yield, again, yield is calculated based on the invested amount. What is the price that you paid? What is the income that you are going to or you earn? The income is the discount. This difference is the discount is your income. You buy the product at this price. If you hold it until maturity, you will get this future value. The difference is the income, or this discount is your gain, your income. So therefore, if you want to calculate your rate of return, it would be discount over price. Again, this will be for a particular number of days. If it is a 91 treasury bill, it would be only for 91 days. So divide it by D and multiplied by 364, then you will get a annualized yield. Clear? much about discounted product. What are the discounted products? In Sri Lanka, mostly common one is in Sri Lanka. What's the mostly common used discounted product?
Treasury bill.
Treasury bill. Okay, any questions on that?
Yield is, you always say per annum. No, sir? Yield?
Yes, yes, yes. You can calculate the holding period yield, that is holding period return as well, but we state it as an annualized rate. If you need, you can calculate the holding period. If I don't do this adjustment, this is the holding period yield. If you don't have this part, when we do this adjustment, it would be the annualized yield. Any other question?
When it say specifically say holding period yield or annualized yield in a whatever the scenario?
Yes, yes. If you have to calculate the holding period yield, it will be specifically asked. Otherwise, it should be annualized.
Okay, thank you, sir.
But even if the yield is given, whether it's yield or the discount rate, whatever it is, if it is not specifically mentioned, it should be considered as annualized figure. Annualized discount rate or the annualized yield. In the market, you don't use a holding period. Whenever it says 91 days treasury bill is at 3.9 annualized rate. Clear?
Yes, sir. Thank you.
So we'll do a last question. The question is about the relationship between discount rate and the yield. You have only about 3 minutes. I think time is over now. You can't. I don't think it's possible now you to answer the question. Okay, what is the relationship between discount rate and the yield? What's the answer? If you go back for this previous example, you pay only 9.667 million to buy a 10 million worth of treasury bill. If you calculate the rate of return, the difference is the discount, but that discount is on this 9 million something. That is the yield that you get, even after annualization. But the discount rate is on this 10 million. Discount rate equals discount over face value. 10 million into P over 360. Even here, this would be P over 364 over P. You can see the difference here is this denominator. In the discount rate, it would be the face value. To calculate the yield, it is the price that you paid. To calculate the discount rate, in the denominator you use the face value. To calculate the yield, in the denominator you use the price. Face value is always higher than price. So therefore this ratio, the discount is the same discount. So this ratio is higher than this ratio. So therefore yield is always higher than discount rate. The yield is always higher than the discount rate. So the answer C is the correct answer. It cannot become equal. If it is equal, that means discount rate is, sorry, it cannot become equal. Yes. If the discount rate is 0, yield also 0, only in that point both become equals. When the discount rate equals 0, that means no discount. You pay the face value to buy the instrument, and at the end also you get the face value. So no income in that case. Only in that instance you get yield equals discount. Okay. Yield rate equals discount. Another thing, we assume positive interest rates. This relationship may change whenever there are negative interest rates. So we'll stop here. Next week we'll discuss foreign exchange and derivatives. Likewise, mostly concentrate on the calculation side. And most of these questions I used are in the questions posted in the Google Classroom. Most of the questions are from that. So even for the past paper, first you try to answer the questions. So try to answer the questions and come up with few questions that you cannot answer or you have some problems, because we may not have time to discuss each and every question in detail. Try to answer the questions by yourself first and come up with questions which are really hard to answer. Even the other questions, I think you got 2 question sheets. Is it correct? One is on FX. The other one is a common one with fixed income, derivatives, and things, covering each and every topic. At least maybe 1 or 2 questions from each topic. So try to answer those questions before you come to the next class. Then if you have any difficulties or cannot understand anything, you can ask questions without waiting for me to do calculations. Any questions? Any comments? Is this helpful?
Yes, sir.
Yes,
sir.
yes, sir. So
Okay.
I have a small clarification.
Yes.
These cinemas are functioning. Why not exam cannot be held? I don't understand the logic.
So the question is, even in cinemas, I don't know. What their logic is. So if we have to conduct the exam, so from all over the country, you have to come here. But in cinemas, so what I suppose, who is living in Colombo won't go to a cinema in Badulla. It's
No.
very I think that's what they have. Or the health authority, that's what they have said. The institute, they have got the approval to conduct other exams, routine exams for the IABF and IDB, whatever, the intermediary and diploma exams, because they are having centers in each area. So people won't mix. But in this case, you all have to come here. That's the logic behind it. There's a, yes, some sense there. Yes.
Okay. Yeah, understand.
It's not from the institution, from the institute, but it's from the health authority.
Health authority. Yeah, I understood. Thank you.
They have not given the approval. That's the problem we have, but probably we will get that. Okay, anything else? If you don't have any questions, we'll stop. But I hope next week you will come up with a lot of questions and problems. Okay, then see you. Thank you very much.